All right, well, good afternoon, everybody. Let me take a minute and introduce the panel. To my far left, we have Jon-Paul, JP Toppino. He brings, I bring 3 decades. He brings over 3 decades of experience in real estate and distressed asset management, which just means we probably grew up listening to the same music.
Definitely. I'm 90s grunge.
There we go. So he is president and co-founder of PAG, which he established in 1997. Some of you may remember Secured Capital, an outfit that was everywhere in real estate. PAG is a successor to Secured Capital in Japan. To my immediate left is Ariel Mark. Ariel's a senior investment officer for Tokyu Land U.S. Corporation, which is the U.S. platform of Tokyu Land, which is on the Nikkei 225, one of Japan's largest real estate companies. Prior to joining Tokyu, Mark directed real estate platforms for, I heard, 3 other international real estate companies in Europe and in Asia. So welcome, JP. Welcome, Mark. And JP, let's start. Maybe you could tell us a bit about PAG and its business in Japan.
So I moved over in 1998 directly from my wedding to invest in non-performing loans in Japan. So we're pretty early investors over there. In fact, Secured Capital, which our predecessor did the first 2 non-performing loan deals acquired by foreign capital in February and March of '97. So for about a year, I was commuting back and forth from Los Angeles to Tokyo, and then I decided I just couldn't do it anymore. So I moved over in 1998, straight from Tuscany. I actually did tell my wife that we were going to go.
She went too, then?
No. Hilariously, she didn't go until I'd gotten shot in the eye with a BB gun in August of that year, and then she felt bad. But so I told Stephanie it'd be 2 or 3 years. Tom knows my wife. In my mind, I thought it'd be 4 or 5 because it'd be unimaginable to me that a non-performing loan or distressed environment could last however long that it was going to last. For a little bit of context, I actually bought some non-performing loans last week that were originated in 1993. So as well as Japan's economy has been doing, there's still a little bit of that left. But anyway, from those early days, through some different roads along the way, Secured Capital was listed on the Tokyo Stock Exchange, actually on the first section for several years. We delisted at the end of the financial crisis. Just our share price was so low, it was a good opportunity to do that. I merged with one of my good friends, hedge fund at the time, which was called Pacific Alliance. At the same time, we brought in Wei-Jin Shan, who's another one of our partners who is running TPG's business in Asia, and formed what is now PAG. So at that time, which was in 2011, we had about $3.5 billion of AUM. Knock forward a decade and a little bit more, and we're about $60 billion of AUM, split between private equity, credit, and real estate and infrastructure. And I focus on the real estate and infrastructure side of the business. Sorry, that was long-winded.
No, that was perfect. Ariel, same question for you. What is Tokyu Land US and what is it investing in?
Sure. And just being on this panel, thank you, Asia Society, JP, you're the man. I mean, that's pretty impressive. So Tokyu Land is a publicly traded company listed on the Nikkei 225. The U.S. subsidiary, we invest as an LP in the U.S. around $200 to $300 million a year from our balance sheet. And overall, I would say our key focus right now is going to be in multifamily and industrial assets. And we've also built out the structured finance platform, which we were reminiscing on and how interesting that is in the U.S. And the U.S. is going to continue to stay a key focal point for Tokyu Land. And the reason's a few things. One, you have, in terms of a stable economy, right? You have risk-adjusted returns that make a ton of sense. But you also have a currency that is relatively stable. So if you take Southeast Asian currencies, for example, or what's happening right now in Japan, you have currencies that are depreciating, like we were talking about. And so if those currencies are depreciating 3%, 4%, 5% per year, having the U.S., investing in the U.S. just provides that ability to say, well, not only am I getting a good risk-adjusted return, but I have 3%, 4%, 5% additional appreciation on the currency. And I think that's a really unique perspective for why we're going to continue to invest in the U.S.
And your LP capital in
Strictly
the US?
LP in the U.S.
Okay.
Which is different than in Tokyo and different than in Southeast Asia, where we invest, develop, manager of all types of real estate assets. In the U.S., it's strictly as an LP.
Any thoughts of, of acquiring finished product in a sort of a value add mode? I mean, could you?
We have, exactly. So one thing which is interesting, so I would say from 2017 to 2021, maybe 2022, the key focus was investing in value add strategies. But as interest rates started to increase, what we've noticed is there's there's more of an interest in debt, in credit type products. And so we're seeing now this interest of investing in downside protection and structured finance. You have risk-adjusted returns that make sense. You have 15 to 20% downside protection. These kind of strategies are not only interesting to Tokyo, but also interesting to other Southeast Asian investors, Asian investors looking to enter the US market, but don't know how. Start with some downside protection. And the US offers that affordability because of the liquidity, the transparency in the legal system. You can't have that kind of strategy in Southeast Asia right now or in other parts of the world. So I think the US still has some key factors as to why Japanese capital and Southeast Asian capital, Indo-Pacific capital will continue to look at the US as a key focal point for future investment.
It's quite interesting because actually as a US investor investing in Asia, I mean, one of the first things that attracted us to Japan, obviously the opportunity set was large at the beginning, but it was actually there was rules of the road. And so, though the legal systems aren't exactly the same, I mean, the Japanese commercial code is based on the UK legal system. And so it was actually, language aside, quite easy to navigate from a legal perspective. And I can see Japan being attracted to the U.S. for the same reason.
Absolutely.
And then, JP, how much? I think you mentioned 2 or 3 billion you're looking to deploy Ariel over the next couple of years. Is that right?
Oh, no, it's consistent around the $200 to $300 million mark, but that's discretion from our balance sheet. And as mentioned, what's interesting now is we're not the only groups wanting to enter the U.S., but we have an infrastructure. So we've invested in the U.S. since 2012. Relatively first mover advantage for a pure play real estate company. Of course, there were some of the trading houses that were here before, but having that expertise, having that track record has now enabled us to bring in other capital who want to partake in the U.S. in a real estate market, but don't know how to start. We are acting as that platform.
Yeah.
Yeah.
Okay. How much will PAG invest over the next year and a half?
So we don't really have set targets, but what I can tell you is over the last 3 years, we've averaged, and this is across all of our business lines, so credit, PE, and real estate or real assets, about $8 to $10 billion per year. And we've divested, call it 5 to 7 over that time. When I look at our real estate business, specifically in Japan, that's actually growing quite a lot. I mean, the nature of the business has changed quite a bit. What you found is that a lot of the large corporates have looked to really streamline balance sheets. I used to make a joke that almost every public company in Japan, no matter what they did, was really a real estate company. It's because they're so asset heavy. And what you have found over the last, I'd call it 5, but really the last 2 or 3 years is that whether it's through better corporate governance combined with a little bit of corporate activism, I never like to give activists any credit, but probably some do. There's been quite a bit of really redeploying capital to strategic businesses. So one of the actually it closed last week, which is why I was in Tokyo. We acquired Sapporo Brewery's real estate business, which is actually quite large, about 550 billion yen, which I call it $3.5 billion now, so that they could take that money and redeploy it to their brewery business and their premium beer and all of that good stuff. So, and you're seeing that quite a bit.
So it's not all, you're not just buying distress. These are opportunistic, but...
Opportunistic, but really more private equity, M&A style transactions. And frankly, our business has gone from as distressed as it gets, which is non-performing loans, to real estate all the way to core real estate.
Is there competition to get for you with trying to get $8 or $10 billion into the market every year?
Yeah, sadly. Every time we find a good opportunity set, Blackstone decides they want to do the exact same thing.
So how do you...
They're not quite as good, though.
So how do you do it? How do you deploy that much without overpaying?
Good question. So I always make the joke, our investors pay us to invest, not buy. You can always buy by overpaying. Investing is buying at a right level. It's kind of funny. As I was sitting listening to this panel and the U.S. being so transactional, that's exactly how not to do business in Japan. You can do a deal once, but the way that you actually have a long-term business in Japan is to actually be a good partner. That means not being stupid. I mean, you have to do what you have to do, right? And you have to be a good fiduciary to your investors, but you don't have to win every single point. And really what you can't do is embarrass people. And I think that's good business policy globally. Don't embarrass your counterparty. Be a good partner. And what you will find, and it's not just Japan, I think it's most places, you'll be able to do transactions on a bilateral basis going forward. Now, does that mean I've got to, get the best possible deal every single time? No, but if I'm not competing, I'm probably getting a little bit better deal.
Okay. Well, let me ask Ariel, PAG is an opportunistic investor. They're in Japan. They're investing in Japan, or maybe some Japan adjacent.
Yep.
That, your market advantages are very clear. Why is Tokyo investing here?
Well, I think it's, JP mentioned it, so it's so true. If you look at Japanese companies and branding and how they're perceived, it's meticulous, it's honest, there's integrity. A lot of what we do in structured finance, you're dealing with shops that are very transactional, or even as an LP, very transactional. But when you hear just the branding of a Japanese company, which is very much true, right? There is a lot of integrity. We are meticulous. It's about the process, it's not the result. What happens is the sponsor is looking at it and saying, you know what? I want to work with that Japanese company because ultimately they're going to be more friendly. They're going to be long-term. They understand how, in Japan, I remember I was just on a tour, well, not just, it was a few years ago, and we have some beautiful office buildings that the parent company built. It took 25 years to put together, but it's 100% occupied, and it's a great property. That kind of long-term partnership and dedication to a partner resonates well with US sponsors. And so that's how we're trying to position ourselves, as we're a long-term partner with you. We can be flexible in the capital stack, and we want to grow.
Although, a lot of people who are building what you're investing in are not long-term. They're dealers. They're not looking. Will you take them out of the deal?
Well, that's also the
eventually?
rub, right? Because generally, as a publicly traded company, we have to balance reputation with profit. And so ultimately, and many Japanese companies are the same, public companies are the same, and US real estate companies are the same, REOCs. We need to generate accounting profits. So we're generally going to be in a deal for 3 to 5 years. So it's a balance between being in a deal for 3 to 5 years while also understanding we want to be with a partner with you for the long term. And we try to balance both.
Sticking with this for a minute, a lot of, I don't want to say a lot, some Asian companies trying to do business here have a hard time keeping pace with their local competition. Local investors can make decisions faster, can implement those decisions faster. They're known to their counterparts in the real estate deal. So, whereas Tokyo may be a bit of a mystery. So I'd ask you, how do you invest without overpaying? So how do you successfully compete without overpaying? Now, I'm going to ask you. I'm asking you this one.
Well, again, everything's about the process, not the results. So we set targets in advance. And what's unique also about Tokyo, and relative to a lot of American shops that are transaction heavy, well, they'll send out term sheets, but not necessarily it's going to stick. What's unique from a Japanese perspective that I've seen is that we've discussed the term sheet with the executive management team prior to submitting it. So we never enter a transaction, and that's the uniqueness. We start at the beginning, we start at the end, and then work backwards. We have to make sure we're comfortable with what we're sending before we send it. We'll not just send it out and see what sticks. What's also unique in the way we've, in modernization, many Japanese companies and international Asian companies, they still have their HQ dictating all the shots. And while there's a certain aspect of that that's going to be correct for any company, what the modernization of what Tokyo's done is have a US office LA and LA and New York based, where the decision making is done in the US. And that ability to do deals in the US make it so that we can move efficiently, we can move fast, without having to necessarily, obviously it's a threshold for capital, but we don't have to go to HQ for every single approval. So we have domesticated the operations, and that element is pretty unique for us, and that's how we've been able to compete with many American companies.
JP, I don't know if I'm asking this after I hear about your beer factory purchase, but are there asset
No, we
classes?
bought only office buildings. They got to keep the beer factory.
So are there asset classes you particularly focus on, or is it purely opportunistic, whatever looks good?
You know, it's funny. I mean, I think as an opportunistic investor, it's easy to say you're agnostic. That's definitely not the case. We do look at where we see, you know, kind of tipping points. So, you know, I know office is kind of a dirty word in the US. You know, we really didn't have that same sell-off in Asia. I know for us, we're kind of like, you know, if things are off 10 or 15%, we think we're getting a great deal. When I go look at downtown LA and things are off 90%, it's inconceivable to me. I mean, the positive news is there's no scenario where I've ever lost all my equity, or more importantly, my LP's equity, but I've also never bought something for 10 cents on the dollar for a long time. You know, I think right now, I mean, it's similar to most places in the world, there's a convergence of infrastructure and real estate. And so where we've historically been office, multifamily, logistics, kind of like everybody else, and we might move our capital around a little bit depending on the year. The last 5 years have been heavily focused on digital infrastructure, and over the last few years, energy transition, which, you know, can be rebranded energy security. I mean, I would say that business is probably the only business that probably is benefiting from the Straits of Hormuz being shut down. Yeah. I mean, not that I want it shut down, not that I want anything to continue, but the reality is you do see countries really focusing on how do I secure energy. And you look at Japan, really doesn't have much in the way of natural resources, certainly no fossil fuel, but what they do have is, you know, they have a lot of wind, they have a good amount of solar, and by the way, they had 53 nuclear reactors, of which all of them were shut down post, you know, the Fukushima triple disaster, which are slowly coming back online. And as you look at that energy mix, you know, I think there'll be a day relatively soon where 90% of the energy is not coming through the Straits of Hormuz. Right?
Okay. So I mean, Ariel's prepared to be a partner and own assets for decades.
Yep.
What are you prepared to do? I mean, how long do you typically
Depends
own
who I'm
these
talking
things?
to. If I'm talking to sellers, I say, yeah, I'm prepared to own them for decades. So
Yeah,
if I'm talking to, our funds are relatively long-term for private equity real estate. So they tend to be 10 plus 2, so 12 years. Fortunately, I don't have too many funds that are like into like multiple extensions beyond that, although I am an investor in a Morgan Stanley fund. Hopefully there's no Morgan Stanley people that actually is from 2000 that I still am not out of. So whatever that is, says 26 years or whatever.
Wow.
So anyway, that's not great. Generally speaking, we're 3 to 5 year holders. Yeah. If we're buying distressed debt, I mean, honestly, we could be 12-month holders, we could be 6-month holders. But if we look at hard asset real estate, we're 3 to 5 years, unless either there's upside that we want to keep on getting, or, you know, the easiest way to grow assets is when there's no liquidity. You can't sell anything, so you might wind up holding 7 or 8 years.
Well, so now how do you know when it's time to sell?
I don't know, crystal ball. No, we do. I mean, we do a buy-sell analysis. You know, we say quarterly. That's not really true. But at the beginning of the year, we look at our portfolio, what we feel like is in position to sell, meaning we've executed our business plan, where there's liquidity. If we feel like there's more downside than upside, we're a seller. And if we're doing our job, we should be buying assets at, you know, somewhere between a 15 and 20% discount to market, realistically. And we'll do that by buying the loan on an asset, being a lender of last resort, good bilateral negotiation, buying something with some upside. Once we've executed our business plan, generally everything we own is for sale.
What kind of rate of return are you trying to target?
So we have a couple different businesses. We have one fund that's really pure core, and that's like an all-in return of 5 or 6%, which sounds very Japan, right? But our mainline businesses are our value add business, which targets 10 to 12% in U.S. dollars, and then our opportunistic business is 17% in U.S. dollars.
Okay.
Good news is you do pick up 1 to 2% a year on your hedges from yen to dollars. So there's a little bit of fudge there.
Ariel, after hearing Wendy talk, I imagine you're just raring to invest in a long-term illiquid asset like real estate.
But that's what's so great. I mean, JP's absolutely spot on. That's why the U.S. is so interesting. The liquidity. If you need to sell, there are buyers, and the bid ask, okay, if you bought in 2021, 2022, you may have bought at a cap rate that's not going to be sustainable today, but with an adjusted cap rate, there is liquidity out there. And that's the uniqueness. I was just talking to an Indonesian investment group and mentioning liquidity, the ability to sell. So are you sure? Are there really those amount of buyers? How can we can't sell, right? We would have to refi. But there are buyers if you need to get out in 3 to 5 years, but also, especially in multifamily, where you have essentially government subsidized liquidity for financing with the agencies, that supports any capital event majority of capital events that you need. And so I think that's another driving point as to why the U.S. is so interesting. And the returns we're getting right now for even structured credit, structured finance, you're looking at 10 to 12%. Can be 12 to 14 if you're doing development, and that's in the U.S. And so that the risk-adjusted return with the liquidity factor is why you're starting to see groups like Tokyu Land and other Japanese and Asian investors say U.S. is a market I want to be in.
Do you guys hedge, or do you basically keep everything in dollars and just keep reinvesting?
In the U.S., yes.
In the U.S.
We'll recycle that capital.
So the money stays.
The money stays.
Okay.
The money stays and doubles down for our accounting profit targets. Yeah.
Are you out, your LP capital, are you looking for a project or are you looking for a partner? What's important to you?
Right. And Tokyo in particular, being a pure play developer, manager, owner of real estate in Japan, we like to be close to the real estate. So we're looking for projects. But which I don't want to jump too fast, but there are Japanese companies that are trading houses saying, instead of just buying real estate, why don't I just buy an OpCo? No. And they have the local expertise. That allows me to be efficient. Tokyo has been unique in saying we're going to domesticate, maybe I don't know if the right word, but have a local team, local presence. That's how we're going to move efficiently. Many other Japanese trading houses are saying, okay, to move efficiently, why don't I just buy an OpCo?
Right. Sekisui.
So, absolutely. Right. I believe
Mitsui.
With CIM, right? Sumitomo, I believe, just bought or is buying Tri-Point Homes.
Yep.
They have bought JPI, who we're a partner with on the project. So it is interesting to see how Asian capital's looking at the U.S. or Japan capital's looking at the U.S. saying, am I going to buy real estate or am I going to buy an OpCo?
I think this is interesting because it feels more strategic than, when you look back to the late 80s. And there's lots of reasons. If you look Japan at the time, things were trading at $5,000 a square foot. You could see how the U.S. looked intrinsically really cheap, right?
Yeah,
which it wasn't. But I feel like this venture into the U.S. over the last several years has been much more strategic, like looking for
100%.
best-in-class partners here as opposed to trying to necessarily reinvent the wheel. So
absolutely.
So, did Tokyo consider buying a platform rather than as opposed to growing it?
We're not necessarily trying to buy a platform. We're trying to become a platform, right, for Japanese capital. So that was another aspect. If we have a local team, we have a local presence. There are many Asian, and not necessarily just Japanese, but Asian capital looking to enter the U.S. Why not have a recognizable brand? So the overseas division, which I didn't mention, but outside of the U.S., we also invest in Southeast Asia. We were talking about different ways to work together there. But that same groups that know Tokyo in that market are saying, well, you have a great presence in the U.S. How can we work together? And so we have explored the idea of an OpCo investment in the U.S., but ultimately I think we're still being more driven towards, let's try to build it inorganically ourselves as being a Japanese platform for Asian capital to enter the U.S., in addition to our balance sheet capital. And that's how you get from the $200 to $300 million a year from a discretionary balance sheet money into $600 billion, $700 million, $800 million, more diversification, more deal flow. And ultimately, hopefully we could do deals with PHG.
Love it.
There we go.
So how much of PHG's capital is deployed in Japan and how much is deployed outside Japan?
So if you look overall, so again, the three businesses, we're about 25% Japan. If you look just at the real estate business, it's more like 50% though. We have about 800 people within PAG, and about 230 are in Japan, and of that, 150 are in the real estate business. We have a Millennium-style, hedge fund who's largely deployed in Japan, so they have another 60. But the other two businesses, our credit and private equity, only have about 20 total. So our real estate business is about 50 to 60% Japan, but overall it's about 30%.
Let me ask, because you're maybe one of the few people, maybe one of the only people I know that...
I'll make up an answer if I don't know it.
Yeah, even if you don't know, that can provide some perspective on operating in both the U.S. and Japanese real estate markets. So how would you compare and contrast?
I think if you look at Japan, it's a high trust society. You have to earn the trust, but once you have it, you have it. Where I think, I started my career in the U.S. investing also in distressed real estate. I'm old enough to where there was a savings and loan crisis that I started investing in. I feel like the U.S. is relatively a low trust society, and so it's all in the real estate business. It's been very transactional for as long. This isn't like a Donald Trump thing. This is a real estate in the U.S. thing. Japan's different that way. I think on the management side, it's obviously more aggressive in the U.S., and that's positive and negative. I'd say, if you look at your asset management, it's mostly positive. In Japan, it tends to be, let's keep the building full. Let's not necessarily push our tenants to pay higher rents. And so that's kind of one of the levers that, as foreign capital, you can add to the market. So, high trust society. There tends to be some low-hanging fruit, although that's squeezing out a bit, where you buy an asset and the rent roll could easily be 30 to 40% below market. Now, rent negotiations aren't as easy as kicking tenants out and moving the rents, so you have to be patient. But adding a little bit more aggressiveness to it is a way to really extract yield out of a country with very little yield, right? So,
I mean, you mentioned trust, and this question really for both of you. The U.S. being, or at least the U.S. real estate being a low trust marketplace, yep. Which I agree, it's very transactional. People want to get a deal done. They're not trying to.
Right. Somebody,
we're not going to the beach together.
Right,
we're doing a deal.
Right. 200 grand could be enough to lose a $200 million deal in the U.S. That's right. Definitely not the case in Japan. If you're, and I think one thing that Ariel was talking about, Tokyo being a reliable lender, making a big difference. Well, I think if you're a developer and you need the capital, you're definitely going to go with the reliable source, even if it costs you some basis points probably. Well, Japan's like that too. If we're a reliable investor, we do what we're going to say. We may not give you the very highest price, but if we say that we're going to be there and we're going to close and we're going to meet your time frame, and everybody's got profit targets, right? Nobody wants to miss their quarterly cash flow. If you say you're going to be there and you're there, then the next time they have that issue, they're probably going to come back, right? So.
And it'd be great to go to the beach with your partner, right? I mean, at the end of the day, we say this at the office, right? A bad contract with good people is always better than a good contract with bad people. Yeah, it's just the nature of how this goes. Yeah. And so we do have a legal system that's robust relative to other markets. I think that is a unique selling point of the U.S. But that being said, we are really focused on that partnership and not having to go through those hurdles. If we know that the guarantor is X, and that guarantor has a reputation for 25 years, very well reputed, we'll actually bring down our cost of capital because we know there's an assurance there. And yes, we're a reliable partner, but also Japanese capital, and this is interesting, it's a question for you that I want to bring up. We have been historically, if you think about it, Japanese capital, low cost of capital, because the yields are so low. And so we've been able to compete on many deals because of that competitive rate. What are your thoughts now with yields in Japan, and how is that looking for what your risk-adjusted return targets are now?
It's interesting. I don't think that it's changed our target. I think it changes how we get there, right? I mean, I think for what we buy, the returns we produce are quite strong, especially at the opportunistic side of our business. But honestly, let's face it. I mean, I have what looks like a really fantastic track record. A lot of it's built on the fact that I could finance at zero for a long period of time. I had lenders who trusted me when times were tough, probably not going to foreclose as long as I was, being forthright and telling them. It's a harder business now. It's funny, when we first started investing in hard assets, so after we migrated from debt to real estate, we'd look at each other and we were just hoping that cap rates were going to drop faster than the rents, because you had 30 years of deflation in Japan and rents were coming down 5% a year. But luckily, cap rates were 6 or 7% in a market where overnight rates were 0. And so there was some forward look that cap rates were going to stabilize much lower. Now it's exactly the opposite. You've got rates really going up. There is some expansion of exit cap rates, but it's the exact opposite. I mean, our rents are growing 10 to 20% a year, at least. And the one place where inflation really helps, inflation, real estate's generally a good hedge for inflation, is construction costs have expanded to the point that there really is no supply. It's a real challenge in my data center business because we need data centers and our customers need us to build them, but rents aren't going up as fast in that business as our construction costs. Everything else, you can't really afford to build an office building right now, and our rents are going crazy. I mean, I think central Tokyo vacancy is about 1%, and if you look at the Class A, it's like a 0.2 or 3%. So really no place for tenants to go.
I mean, that's what a contrast to the marketplace here.
Well, I know. I feel like I could move into an office building and just live in it.
They pay you to
Take the whole floor. Yeah. Hey.
Absolutely. And you can't compete with 10, 20% rents. We're not getting that in the U.S. at the moment in terms of that rent growth. There was a time when the value add strategy, which a lot of groups implemented, because cap rates were compressing and rent growth was 5 to 7%. You can generate, you don't have to have operational efficiencies and have that real manager expertise to make money. And now it is required. So what's also a benefit to the U.S., you do have diversification. The Japan market is doing fantastic, but if there is ever a turning point, it's nice to have that diversification. So that's why you're seeing a lot of Japanese publicly traded companies double down on their overseas initiatives, whether it's in Southeast Asia or in the U.S. For that reason, there are times, we do believe right now in multifamily, you're starting to see a supply cliff. That will generate rent growth, right? And so it's good to have that diversification. But you're right, the Japan market is doing fantastic.
Yeah, I think you have an interesting, if you look at the dynamics for multifamily in the U.S., I mean, rates are high, likely to go higher. I think there's a real squeeze on new acquisitions, especially for younger couples that are going to be renting, and you don't have a lot of supply because construction costs have gone up. I do think this is kind of that magical time to be an investor in that sector in the U.S. Man, I might move back.
Let's go. There we go.
I mean, here, it seems like
we're going to partner.
You can buy product cheaper than you can build it. Right?
For sure.
So, I mean, it's a different kind of marketplace here.
Yeah, everything's discount to replacement cost. I mean, 20 to 30%. That's actually normal. And we don't necessarily look at that by itself. That could be a value trap. So you really have to see, okay, what's going to generate that rent growth? What are those drivers? And a lot of it has to do with AI, semiconductor. And so, I agree with you on the data center space, but obviously those checks are, I mean, how big are those checks that you're talking about right now?
Really huge. I mean, especially in Japan. I mean, it's actually, I shouldn't talk against my own book, but it's a really inefficient sector for the data center operators. It's $20 million per megawatt to build in Tokyo. To put that in perspective, it's about 8 in the US and it's about 5 in India. So, I mean, obviously you need data centers in Japan, but I would not really foresee it becoming like an AI hub necessarily, because the cost is huge and you've got real power constraints also. Sure. I would say for like AI hubs, you're probably looking a little bit more Southeast Asia, and India is probably the best because you have excess power, obviously workers that are highly educated, and the building costs are pretty low. Now you have to get over the fact that you're investing in India.
But I've always known, real estate people are the most positive people in the world, right?
We'll keep smiling straight through foreclosure, man.
But
that's it.
But I
It's
mean,
a good buying opportunity.
After the last panel, I think I have to ask, what is it that could happen?
Yeah.
I mean, given everything that's happened, and you guys are so positive, what is it that could happen that could derail all this positivity?
I think not positive. We're prudent and
optimistic but vigilant.
Exactly. I mean, everything can happen. I mean, it's easy to start with geopolitics, but like if you look at a country of Japan, which is non-resourced, massive energy importer, having a huge rift with its largest trading partner. I think most people don't realize this, but Japan-China commerce trade is 20% of Japan's total trade versus 14-15% and going down in the U.S. And there's a huge rift there. I mean, we don't own a lot of hotels at the moment, but inbound tourism from China, which really drives inbound tourism in Japan, is off over 50%. And all it took was Xi Jinping to say, Japan might be dangerous for Chinese. And he only said that because of, Takeichi-san's comments about Taiwan, but it might be dangerous for Chinese, which really meant don't go to China unless you want to have trouble back here, and don't go to Japan unless you want to have trouble back here with your bank accounts in China, and it made a big difference. So a lot can go wrong for Japan, and they really do need to straighten out the geopolitics, and riding that knife edge between what they need with the relationship with China versus what they need with the security with the U.S. is a real, it's easy for a country like Singapore. It's a little more difficult for Japan, but they need to figure it out, or we need to figure it out. Because if we
Spot on. I mean, I agree. I echo that sentiment 100%. Because obviously, if you're just looking at higher interest rates, or there's opportunities depending on what risk factor could just distort the market, that's where opportunity is, right? When there's blood on the streets, it's time to buy. At the same time, we're just having to be vigilant, because if you do have certain macroeconomic factors that are going to distort what we feel is a good price, what's going to happen is there's just going to be a lack of deal flow. So as an LP, we have that ability just to not do anything.
Yeah.
You need an event.
We need an event, right?
Well, thank you both. This has really been an interesting panel. Let me open it up to questions. Anyone in the audience have anything they'd like to ask? We covered it all?
I have subscription docs if anybody wants to invest.
There we go.
Thank you guys for being here. My name is Strauss, so I'm with JP Morgan, so not the other Morgan.
I probably have some bad investments with you guys too.
Fair enough. That's why I'm here to ask some tough questions. Had a question about how you guys managed the yen carry trade unwinding in 2022, any flow through to the real estate portfolio, especially for unhedged U.S. denominated assets. How did you manage during that period, and what are you kind of growing out of for that? Yeah. And then second question would be on kind of tax efficient investing around your vehicles. I now have access as an asset manager to a digital infrastructure play that's 100% return of capital.
Right. That's
increasingly important for people that are thinking about tax efficiency around the new transformation in real assets, but also digital infrastructure. Yeah. So where does that fit into the conversation? Thanks.
On the yen carry side of it, I mean, obviously it was kind of a free boat for everybody, right? I mean, 2 years ago, I would say there's no better place to be than be a US dollar investor investing in Japan, right? The yen's cheap, and you're picking up so much on the carry. You're still picking that up. But, what was 2 or 3% per annum is down to about 1 to 2%. We fully hedge. We basically hedge 100% of capital, obviously, and then, we'll hedge all of our cash flows, but not profit until we start getting closer to it, which means, when the yen weakened quite a bit last year, we probably lost a little bit, but only on future profits. So not really very material. It could be 50 basis points at most over the life of the fund, something like that. In terms of the tax efficiency, the only place that you really are missing it, so obviously we structure as efficiently as possible. There's a really fantastic Singapore-Japan treaty, which brings, it's not super cheap, but it brings your withholding taxes down to 12 to 13%. For a taxable U.S. investor, it's a wash. It's an offset against U.S. taxes. Where there's friction is for your tax-exempt investors, right? Your endowments, your pension funds or what have you. We basically have to price that tax friction in. So everything we look at is post-tax, post-promote, post-everything. So that's kind of our net return baseline.
Makes sense. I was just going to say, and what I mentioned right at the beginning is, the hedge side, we have the Treasury Department, but just looking as a pure play investment in the U.S., if my currency is depreciating, whether it's Japan or take Southeast Asian currencies depreciating 3 to 5%, so in addition to the 12-14% risk-adjusted return that I'm getting in dollars, I also have that appreciation in the U.S. Relative to my local currency. So that's a benefit, net benefit for the U.S. Right? So That's positive. Now we'll see how long that lasts. But continuously, that's been the case for the past 10 to 15 years. And tax efficiency, we've also been looking at how to be, what are some, and not necessarily just for us as a parent company, we're focused on accounting profit. As a public, most Japanese public companies are focused on just accounting profit before tax, and just how is that return going to look like. But in the structured finance space, for foreign investors, one thing that we're also understanding is what is the most tax efficient ways for them to enter the US? And there are actually solutions to invest in US debt as a foreign investor where you don't pay any withholding tax. So there are tax efficiencies investing in the US that we're figuring out how we should allocate our capital and what would be interesting to capital outside of our balance sheet.